So welcome everyone. The next two panels are really going to focus on these reporting frameworks, DAC8 and CARF. This first panel, we're really going to dive into what are these frameworks? What do they say? What are the requirements? What are the gray areas of the requirements that I think will impact the next panel, which really talks about operationalizing. So with these new reporting frameworks, you're going to have to look at your processes. You're going to have to look at the data you're collecting. You're going to have to even see if they apply to you as an enterprise and ultimately understand how you comply with them. So just setting a little bit of context up front, DAC8 and CARF. CARF is the Crypto-Asset Reporting Framework. It was finalized in fall of 2022 by the OECD. A year later, we had the European Council's DAC8 directive finalized, which is the EU's implementation of CARF. If you're asking yourself, what does any of that mean? We are going to explain it to you during this. But at a very high level, these frameworks require certain enterprises called, here comes another acronym, RCASPs, Reporting Crypto Asset Service Providers, to collect various customer data points as well as transaction or payment information, and they have to actually then be able to report them locally to the relevant jurisdictions on an annual basis. So with that context, I did want to hand it over to have an introduction of my fabulous panel of speakers. So Layla, do you want to go first?
Yeah, hello. Layla Majed, Head of Tax of Société Générale Securities Services and Tax Supervisor of SG Forge.
Paul?
It's already good if we can make the technology work, of course, major progress. I think Dion and I, we were up for a little experiment, so I'll introduce Dion and Dion will introduce me. Dion Seymour is the Crypto and Digital Assets Director at Andersen in the UK, but also very importantly, he was the United Kingdom delegate in our OECD working party when we developed the CARF, and so I've known Dion for a number of years, and I can certainly say that he was a very active and important contributor to the design of this framework, and it's of course a big pleasure to be with him and with the two other panelists on this panel this morning.
Thank you, Paul. So I'm going to introduce Paul. So Paul Hondius, he's the OECD Secretariat for Working Party 10. Now, Working Party 10 doesn't sound very interesting, but it is the one that deals with a lot of the information reporting that we actually deal with. And Paul and his counterpart, Philip, are excellent negotiators trying to get international agreement and accord, which feels appropriate to say at this summit, amongst jurisdictions that really don't necessarily want to see eye to eye. So really, really tall order, and it might sound simple creating an agreement between members of the Working Party 10 at the OECD, but it's really not.
Awesome. Well, if that doesn't highlight how fun this panel is going to be, you thought information reporting, and we already have jokes and all kinds of fun stuff to come. So my first question is to Paul and Dion. Can you really help our audience understand what is the purpose, behind CARF? What are the elements of CARF? And just starting to highlight what are the differences? Because you think DAC8, it's just an implementation of CARF, but there are some important differences with DAC8 that, those in the audience should be aware of.
Yes, so maybe I give it a go, and then I'm sure Dion will complement. So I think the CARF in a nutshell is a global automatic exchange of information framework between tax administrations on crypto asset transactions. I think in terms of the genesis, it is comparable with the common reporting standard on financial accounts that we developed about a decade ago at OECD level, which applies to financial institutions, so to traditional banks. And I think the CARF is a response to an appreciation among participating governments that the tax transparency and information reporting regime that we had for the traditional financial sector did not apply to the crypto sector. And in light of the development of the crypto sector and it becoming more important for large parts of the population as an investment option, we started work in the Corona period on developing this framework. And as Erin has said in her introductory remarks, this was approved in 2022 and is now being implemented across the globe. And I think thankfully we have a very good coverage of jurisdictions participating in terms of where the relevant crypto markets are. And of course, if I say implementation, what that typically means is that our model rules that we design at OECD level then get introduced into domestic legislation. And given the particular regulatory framework that the European Union has with its own legislative powers, this then led to a directive that is now known as DAC8 for the 27 member states. And I guess, Dion, you can probably say a lot about what is the same and what is different between those two.
So what I will actually say very quickly is that quite clearly CRS and CARF are quite different. You couldn't make the traditional TradFi regulations work in this information reporting. So one of the biggest changes, for example, CRS will look at a year-end figure for financial institutions to report to the different participation jurisdictions. Clearly, in this on-chain world, it would be so easy just to remove your crypto, if you will, from a centralized exchange and put it into cold storage on any year-end date, which is why big change between CRS and CARF, and for DAC8 for that matter, is that it's actually looking at aggregate balances or aggregate transactions that are occurring through the year. For DAC8, can I say this, Paul? I don't know, I'm going to say it anyway. One thing which we were worrying about during the negotiations, and as Paul mentioned as part of the UK's leading point of the negotiations, where we were worried about the European Commission swooping in at the end, once we've got all of this agreement, once we've got all of the accord, and then basically bringing it in and gold-plating it into the EU standards, which is fundamentally, I think, what happened. We did an awful lot of the negotiations, starting way back in 2018, so before COVID, and again, a lot of hard work had already been done trying to say, well, look, we can't just do year-end balance, we can't do all that. So DAC8 is quite often seen as just being the same as CARF, but it's not, but it does use CARF as almost like the opening standard. Now, some of the variances that you do necessarily potentially have, and it's great to have a little bit of debate, is who participates and who doesn't. So with DAC8, the European Commission says, European jurisdictions, you have to participate. So they are in, whether they like it or not, they would just be dragged along. As we've heard, we've got quite a lot of participants with CARF, so we're up to 67 jurisdictions at the moment, most going live from the 1st of January 2026, with some who are delayed by a year, about 13 or so. Now, of that one that's been delayed by a year is the US. Now, show of hands, quickly. I've got to do a little bit of participation. Who thinks the US will continue to want to participate from what we've seen with the current environment at the moment, shall we say? Show of hands. Anyone? Put your hands up if you think the US will carry on to be involved. Brave guy. one hand up. And I think this is going to be the really interesting point. And actually, even before the current Trump administration, participation of the US was highly, highly questioned and deliberated. Now we're seeing with the Trump administration being much more keen on bilateral agreements rather than multilateral agreements. The US is still currently listed as a jurisdiction that will participate, but will they or won't they? Paul, did you want to make any comment on that?
It's good that we start the panel with easy questions. I think what I can certainly say, and this is true for I think very much up to the day as we speak, is that the US, as Dion said, is committed to implementing the CARF and made a commitment at the level of the Global Forum, which is the body at the OECD that monitors the implementation of international standards, to implement the CARF by 2028 at the latest. And I think so far, and this is also true for the period after January 20th, the US is engaged in the work that we're doing and continues to be engaged in the work that we're doing. And so I think all that I can say, apart from the larger political landscape that I think we all see, is that in our work, in our day-to-day work, there continues to be productive and positive engagement by all 67 that are currently committed, including the US.
Dion, you said something really important. You know, you could not take traditional financial reporting models and just fit them into crypto. And we're seeing that from a global landscape. So we're going to get into CRS with just a minute, which I know is near and dear to Layla's heart as she's already impacted. But you see that globally with CRS versus CARF, and then you see it in the United States as well, right? In that case, Treasury trying to fit crypto compliance into these existing frameworks for traditional brokerage. And so, Layla, I think it would help to help the audience to understand, you know, what is CRS? And how are you looking at it in terms of having an institution that's both in traditional financial equities and then crypto as well? And what challenges is that going to bring?
Thank you. Yeah, to build on what was just said, I would like actually to emphasize that both CARF and DAC8 are not only incremental update, as Dion said, they are really targeting, they are really actually creating a shift because they are targeting new actors, many of whom have never been subject to any automatic exchange of information or tax reporting regime. And I mean, I like to borrow a quote from a very insightful article. It's called "Old Tricks for New Dogs," the CARF. And actually, it's very, I mean, it's a very telling phrase because old tricks, it's the CRS, and new dogs, it's about actually the new actors, many of whom have never been actually, they are like stepping into a new world of compliance, and they don't have actually the regulatory culture or the IT system to support this, while financial traditional institutions have been adapting to this over a decade. But meanwhile, even for this actually financial traditional institution, there are really challenges because when they want to actually go and provide services on crypto assets, there are many questions they are asking. For example, on classification, I mean, they're classified as a like depository institution, or they be classified as ARCAS, or is it anticipated that we can have like this two-like status, and what are the implications? And also, this all create uncertainty on the implementation and even on the due diligence side for even financial traditional institutions. But beyond all this classification and due diligence, the thing is, yeah, because the two market, the key driver of the two market are really different. I mean, CRS, this is my understanding, was created for like, let's say the traditional asset like bonds or share. We are really like income generating assets. And it's also the reporting. The reporting is really account-based reporting model, and even the due diligence occurs at account opening. CARF, by contrast, I mean, is really targeting a new category of assets that, but naturally, they are not, I mean, income generating assets. So that's why they need another, I mean, that's why actually the OECD created a dedicated standard for this digital asset. So all these questions, actually, we have to keep in mind that we are not actually layering new rules on existing rules. They are really fundamentally different approach with different actors and different assets. And we should find a way actually to seek alignment and harmonization between these two regulations.
Yeah, I think it's a really good point. So with CRS, it's called the Common Reporting Standard. It applies to financial entities primarily. So think of it, you know, you have your depository or custodial entities, and the first wave of reporting was what I would call very vanilla. Account balance, you know, how hard is it to find Erin Fennimore's account balance at your company and report it forward? Compared now to what we're seeing with CARF, and it's going to prompt my next question. To me, it's not vanilla. You know, having to, it is not just account balances. It is looking at all of the relevant transactions. You have to actually determine, do you fall into those relevant transactions? And then we have this concept of aggregate reporting by asset type. So, you know, Dion, I'd love to hear if you could just help us explain what is this, you know, aggregate transactional reporting, and what are some of the complexities?
Wonderful question, Erin. So we really are getting into the depths of how CARF works. Now, as I mentioned earlier, year-end balance on CRS for the Common Reporting Standard. It's kind of difficult to manipulate. So when CRS came in, I was part of HMRC. I was actually part of the fraud investigation team dealing with offshore matters, and so CRS is quite relevant. And looking at how you could gain CRS was quite hard. If you have your €1 million in a bank account at the year end on the 31st of December, it's very hard to take that out and put it somewhere else just for that overnight timestamp. But as I said, you in theory could go to your bank and withdraw all the cash that you have, hold it under your mattress or your chosen safety deposit box of choice overnight, and then go and put it back into the bank the next day. But it's high risk, high effort for quite low reward necessarily, particularly during the period of low interest rates and most places not having wealth taxes. With crypto, again, doesn't lend itself that way, because you could do that if the reporting crypto asset service providers are mainly the centralized exchanges by the likes of Coinbase, say. It would be very simple to withdraw it from Coinbase, put that into your cold self-hosted wallet, self-custodied. That wouldn't be a relevant crypto asset service provider, so there would be no reporting obligations upon that. Therefore, you can easily do that from the comfort of your armchair while watching the fireworks outside your window on New Year's Eve. Therefore, we had to look at it very differently. So aggregate reporting could be the only way you could actually get that information to try to prevent or try to reduce and minimize the gaming of the system. So the transactions that are occurring throughout the year to be aggregated. So it was a simpler solution. Balances actually were a very contentious point. Some of the delegations were very strongly against account balance or year-end balance being used as a determinant factor due to their reporting mechanism. So aggregate had to be the only way forward.
Yeah, I see you raising. Paul, please, anything else you want to opine on this?
Yes, and maybe just to throw in one more. I think Dion has highlighted one reason why we ended up with these aggregated by crypto asset type reporting obligations on transactions that took place over the year, both in and out, of course, both acquisitions and disposals and transfers. One other reason that I think is equally important and maybe tells something about the broader landscape that crypto currently still is in, is that if we would have gone for actual transaction by transaction reporting, potentially also with base reporting included in it, that is only a credible proposition if there is a almost perfect or perfect harmonization of the substantive tax laws of the countries participating in the framework, because what you're then suggesting is that you can actually immediately use this kind of information to determine tax liabilities. And for those of you familiar with the US 1099B reporting rules, that is of course very much the working proposition under US legislation. Now that's just something that I think in all honesty not even in a European setting, but also not in a global setting, is not something that is realistic or desirable, I think, to come up with something along those lines. And so we were always working on the basis that this should be informative to create a picture on holdings and transactions of taxpayers in the crypto space, but that it could never be an automated reporting regime to apply a lump sum tax rate or to immediately determine whether something is a taxable event or not. And so that was also an important reason to minimize the amount of data that is going to be exchanged through aggregation, and to make sure that it is more usable as an overall picture to determine how active somebody is and what the amounts and transaction volumes are that are involved, rather than pretending that this could be used by a tax authority as an immediate means for applying a tax liability.
May, Paul. Whilst negotiating at the delegatory level, I did highlight this as being a problem transactional. So you can obviously have people in crypto who do a lot of transactions who don't actually make much money. You know, lots and lots of microtransactions. Now, for a tax administration, if they got everything line by line, they will have to do work to try to identify those characters who are low value but high frequency versus those who may be more high frequency, high value, if you will. So as part of the negotiations, I actually invoked my son's name in the middle of the negotiation. So my son's Jared. He does a lot of mining. He does a lot of little transactions where £50 is a lot of money for him as a student, you know. And so he's like, woof, £50. And, you know, in my mind as a tax administrator, I don't want to find the Jareds in the data. I want to find the Pauls in the data, you know, the high values, the wealthy, who are trying to hide themselves. And yeah, so that was an actual legitimate actual negotiating point I said in the negotiation. So data, lots of value can be derived from data if you can actually manipulate it. And we've seen with the 1099 DAs, with the IRS getting millions and millions of lines of data, it's very hard for them to trawl through to find the individuals they're interested in.
Yeah, I know, and I know we're gonna, you touched on one thing, like by the asset type, right? Aggregating the transaction activity by the asset type, and I understand kind of these conversations, but I think there's a lot about crypto that is constantly evolving that's gonna cause challenges with just how exchanges, and I'm going to put it in the exchange context because I think that's the most clear use case right now. But on my next panel, we're going to touch on this, so I don't want to dive too deep, but we're already seeing this on the US side as well. What happens if you have, you know, a token split, or you have a wrapped? Is wrapped Bitcoin and Bitcoin considered one asset type, and should you aggregate that? Should you aggregate them separately? So I just think that there are a lot of open questions on the how still. So just curious if you even dove into some of those. The assets bring a lot of complexity because they're constantly evolving.
We certainly did, and this is where it's quite important. So in 1 year, it opened up, we were looking at DEXs versus centralized exchanges. I literally said, we don't need to worry about those. We've got the volumes from chain analysis. The volumes are quite low for DEXs versus the centralized exchanges. By the end of that year, it completely changed. And this is the picture, you know, it is a moving picture. And we heard it on the panel before. Who would want to be a regulator in this kind of field? Everything changes rapidly. Real world assets were discussed, for example, as part of the negotiations, but the incidences of them were very low at that point. So it's very hard then to say we would need to spend a lot of negotiating time on this. And it becomes almost like Pareto's law, the 80-20 principle, that you're going to need to focus most of our time on the difficult things. But I think it's a US delegation who often said, don't let perfect become the enemy of the good. I think that was Erica's comment a lot. Where you can become so focused on some of these more outlying aspects, but sometimes you just need to focus on the big things. But things like, does wrapping actually constitute a change of assets, has come up and does continue to come up. And so.
Yeah, maybe some additional points, and also I think this is the moment where I would like to very much invite those of you in the audience that are actively involved in this to also join the conversation. I think I was just speaking in the break to Caroline, who is of course also very much familiar to the OECD world, and I was saying. By the time we were in the same stage of implementation for the common reporting standard, banks, insurers, the fund industry were pretty much on our neck on a day-to-day basis with questions in terms of how do we report this? Is this a reportable asset? Is this not a reportable asset? Should we treat this amount on this basis or on that basis in terms of calculation methods? And through the OECD Working Party, and we have that instrument also available for the CARF, we came up with additional guidance, frequently asked questions to clarify these points. And so some of them have been raised, for instance, the question of wrapping, staking, crypto loans, decentralized finance certainly. But I'm sure that there is much more, and things that are very relevant for those in the industry that are trying to be compliant from the outset and are building the reporting systems and asking these questions in terms of, am I in as an entity, or is this asset to be reported or not? And I think certainly bearing in mind that this will become legislation in a wide range of jurisdictions, it's in our interest to make sure we have a good functioning international standard, but I think also very much in your interest to try to use this avenue through the OECD to get guidance that then is very likely to be followed across the globe, rather than having all these national differences. All this to say that I think if there are other issues that you think are relevant, are unclear, require additional guidance, to approach us and bring those issues forward, we're very happy to take them on board and see if we can get a multilateral understanding on how that should be applied, so that you don't have all these differences. As the saying goes, I don't know if this is a Dutch saying maybe, but typically, 12 people, 13 opinions, right? So
Yes.
if you can align that a bit, that's, I think, helpful for everyone.
Yeah, I think that's a great point. And basically, you will be the busiest person at lunch, and everyone will be sitting at your table, is what I'm hearing. All the questions are open. I think one other topic I really wanted to touch on, because I'm seeing this across, especially in the traditional financial context. So a lot of traditional financial institutions are a bit wary of jumping onto the crypto bandwagon, but they're using blockchain technology in a variety of different ways to streamline operations. Tokenizing deposits, using blockchain technology with movement of, assets internally. And the biggest question I get, and I'm really curious, Layla, because I'm almost positive that you already have this happening internally. They think, oh my gosh, does that mean I'm automatically within these new frameworks? And I think there's just some confusion there. I'd love to hear your thoughts on that, of how you approached it.
Yes, indeed. From a systems and implementation perspective, for sure, DAC8 and the CARF actually add a layer of complexity, especially for financial traditional institution like Société Générale or other banks, because it's not only about, identifying reportable transaction, as have been really well addressed by my fellow panelists, is about, as you said, Erin, how actually to more practically capture a process and report and build systems where actually blockchain and DLT are involved. But at the heart of all this lies a more, let's say, fundamental policy question that I would like to ask to my fellow panelists, is the mere use of DLT should trigger, additional reporting obligation above an existing one? Should, for example, we're still dealing with financial assets that is already subject to financial regulation and tax reporting. So it's hard for us to understand the rationale behind adding additional tax reporting. If I take the example of a bond or a share, it's just the fact that this bond is tokenized. We're using, as you said, actually like the technology, but it still is a financial instrument that have all the characteristic of a financial instrument. So, from our perspective, we're creating overlapping in terms of systems, in terms of reporting for the same underlying financial instrument. And we have a lot of questions. Also, from tax authority, how they going to use this, data? How they going to use it really meaningfully? How they going to reconcile? How they going to, act on this? So, yeah, a lot of questions.
Where do we start? A lot of questions there. So for tax authorities, start from the end, the tax authority aspect is going to be very important, and the operationalization of data is key, because there's no point gathering data for data's sake. Certainly in the UK, there was a case recently where where there was an argument against the use of CRS data. Moderator took the case, famous for being Princess Diana's divorce lawyers, but they were taking that through the process as to whether or not it was actually relevant data to be collected. I think there's also the aspect here about duplicate reporting that you mentioned, and there is a switch off for duplicate reporting. Now you can duplicately report if you wish, if you want that to be easier, or you can do the switch off mechanism and then make sure that you aren't actually duplicating reporting. So that was considered during the part of the negotiation, so I'm sure Paul will expound on that. How that might play out with duplicative reporting from a tax administration's angle could be slightly difficult, because they're used to matching data against an individual to say, has this actually been, or does it actually appear to have been reported on the tax returns? If you have duplicate reporting, it's trying to make sure that that information doesn't then overstate what they expect to see from that individual, because if they're getting it twice, then that might be problematic. And so as long as the tax administration can actually identify where our reporting crypto asset service provider or FI has actually indicated they are duplicatively reporting, then that would be the main thing. But I'm slightly outside of the HMRC loop these days for that side of stuff.
Yeah, so maybe just to add to that, and hopefully trying to answer your question, even if it may not be fully satisfactory. I mean, I think when we were negotiating the CARF, this issue was considered. So very concretely, the use of DLT in the traditional financial sector. And we consulted at the time with business on this in terms of, is there something we should do? And the response, and this is sometimes a bit unfortunate in the sequence of timing and how regulatory developments go and how technological or market developments go, the response at the time was, well, we don't really know what our ask is because it's all so nascent and so unclear how this is going to be used that we can't really formulate at this stage a request for an explicit exemption or a hierarchy rule. And so what we ended up with is what Dion referred to, which is that we have to switch off possibility between the common reporting standard and the CARF, where a financial asset is at the same time in tokenized form and qualifies as a bond or a share for CRS purposes in a custodial account. So that we have that mechanism to avoid that. It's on an optional basis. That was also an ask of the business community to not be forced to have to do this triage every time, whether something is in a more traditional format or in a tokenized format when reporting on financial assets under the common reporting standard. Now, all that said, you know, this is sort of the part where, you know, the defensive part, right? Should of course try to switch that over, because at least we had at the time the foresight to have a hook in our commentary to say that we could reconsider the treatment of tokenized assets in the financial sector. So we have that in the internationally agreed standard. And so also here, I think we are very much open to hearing real life issues and real life experiences about how this is developing. I mean, fundamentally, I'm not sure if I like to say it, but I mean, I am of course a bureaucrat, right? I'm not in the financial sector, not in the crypto sector. So we always rely on you to tell us what is happening here and whether this is becoming an issue. So all that I can say is that there's certainly an openness, I think, also with the governments around the table and with the OECD Secretariat to reevaluate this and to see if we can be more specific. To address this, because I think, as you said, there is no interest in having meaningless, duplicative, or even weird reporting that reflects internal transactions or something like that. I mean, there's no interest in that, of course, and that creates its own problems if that were to be the case.
Well, I know we focused a lot on the activity, on the transactions, but I want to shift us over to the customer aspect of this. And Layla, you brought up a really good point earlier, you know, that kind of balance of traditional financial entities and having a baseline understanding of compliance compared to crypto native companies. And I encounter this all the time. Crypto native, you know, just entering into the compliance world, just understanding, especially from the very top, why do I have to do this? Why do I have to fund these projects? Do we have to ask our customers all of this information? You know, is it gonna hinder the success of getting customers on these platforms actually transacting, which is how they make money, obviously. So I wanna shift over to another part of CARF that I think is often overlooked. And for everyone out there, the reporting, we have some time, right? We have some time to work out these kinks, to wait for these jurisdictions to finalize their local implementation, the portals, everything that needs to happen before actual reporting can be submitted. But starting in January of 26, the onboarding implications are going into effect. What that means is under DAC8 and CARF, you have to collect now what's called self-certifications. That is an actual form. It has specific data points you have to collect. And, you know, I'm just curious, given that you're already under CRS, Layla, you know, do you see a huge shift to this onboarding aspect? You know, having to collect these self-certifications, or do you think, you know, generally since you already are, it's not going to be as much of a, you know, burden?
No, I think there's a like, it will be, I mean, I won't say it's a burden. The thing is that indeed between the CARF and the CRS 2.0, we can rely on this existing
Yes.
self-certification. So it's allowed to rely on the certification. The question is whether, I mean, the existing self-certification is sufficient or not. And also, from traditional financial institution perspective, the question is between, let's say, new client and pre-existing client.
Yes.
So for a new client, of course, it will be more, I mean, easy to collect, let's say, the new self-certification. And for pre-existing client, the question is whether to rely on, like, self-certification, if it's sufficient, or also to align, I mean, the process. So all these questions we are questioning we are questioning all these questions, and we have, to build system on that. But the most difficult questions for us is, as we said, I mean, the CRS, it's the due diligence occurs at account opening.
Yes.
So for the CARF and for traditional financial institution that are also CASP, the question is, what really triggers the due diligence? I mean, is it by creating the wallet? Is it by, I mean, when the customer engaged in the transaction? Is it at the moment of the subscription of the product? I mean, we're a lot of questions, because within CRS it was really straightforward. I mean, account opening. But within the CARF, and this is like, a very important point, because we know that the customer become really visible at the time of transaction. So that's why we understand that to become even in our CASP, you have to engage in exchange transaction. So we are asking all these questions about the trigger to due diligence.
I love seeing everyone just grab for their microphone, wanting to speak. That's the best type of panel I can have. So I will hand it over to you, Paul.
Yes, I'm now going to be a bit cheeky because it's the moment where I can be, right? So I mean, I like the fact. I mean, that's good news. I think I like the fact that you're saying, well, it's so clear for the CRS because it's obviously upon account opening. I mean, I can tell you we spent years trying to specify the concept of what it means upon account opening. For instance, in the fund industry, and whether it's realistic to always require that on day one, and how many days grace period we should grant, and they were very controversial. Look at FAQ 22. I know that number because it was so difficult. So all that I'm saying is, you know, the CARF obviously has this notion upon establishing the relationship with the customer, right? And so I think that is one of those key issues that, in order to make this practicable, workable, reasonable for business, where we need your input in terms of like how does this actually work? So where can you actually successfully do this? And that's of course and always will need to be balanced with the interest of governments to not have cases where people then remain undocumented and can still do transactions, because that of course in this very fast-paced environment can be a big problem for tracking down cases of tax evasion. But I think they're very much, and I'm sure that the Société Générale business model will be different from the business model of somebody that is only engaged in crypto. And so I think this is one of these things where I would very much say there is a window of opportunity to get this right and make this workable. And I mean, the rules are what the rules say, right? And they create a principle. But then I think that, of course, there needs to be worked out in further detail what that then exactly in each case could potentially mean.
And if I may just add in quickly, we keep talking about this business bit, the business of business. So I think it's probably good to highlight for Working Party 10 that there's actually a business advisory group that's attached, and there's a specific one for CARF, for which Max, okay, he was here a minute ago. Yes, of which Max and I are co-chairs on the Business Advisory Group. So if you aren't already aware of the Business Advisory Group for Working Party 10 and for CARF, feel free to drop Max or I an email, and then if you've got questions or things that relate to the introduction, as Layla was saying, what about this, what about that, how does that work? We would do that, and then we would send the stuff to Paul to answer. So that's how it works. But yes, so the OECD is active in trying to get information or trying to collaborate with the community to try and make this work. So at no stage do I think that this is just more like a bureaucratic function, to pick on what Paul was saying. I don't think it's kind of trying to be imposed. It's trying to be understood and worked with to create, because Governments want this as much as, I won't say industry, because industry clearly doesn't necessarily give them an additional cost, but governments want this, and if we want the industry to be seen as maturing and to be as relevant, should we say, as if TradFi world, it is part of the cost of that impression.
I think it's really important, though, for everyone to understand that there's a couple different areas where I see CARF and DAC8 differ, right? One of the biggest areas, I think, is with the self-certification, this onboarding aspect, you know, as a RCAS, so let's say you fall into these DAC8 regulations and you have to start collecting these self-certs. What is that? It's an actual, you know, form that collects customer information. It differs in a variety of ways from your general KYC process, so that's one, the first important thing to understand. But second, and Dion, I'd love to hear your explanation of this, what do enterprises or exchanges have to do if they don't collect that self-certification form? You know, and that's really where DAC8 differs from CARF. And I'm wondering, you know, Paul, I'd love to hear your thoughts on why did that happen?
So if you don't get the information on the self-cert, fundamentally you have to stop. Having the engagement, being able to do the transactions. And I think to an extent there's also going to be domestic approaches to what that penalty would actually look like. There is a big challenge as well with self-certs with enterprise because one, they are also not wanting to look like they're the bad guys. They don't want to look like the ones asking for the information because in this space you can quite often have phishing attacks whereby you get asked for the information and they're saying, oh, should I be providing this? And so just very quickly and separately, we are also working with a number of trade bodies to try to create a template which would go to the business advisory group. You know, the bodies include GBBC, GDF, Crypto UK. Obviously, Max and I are involved in that as well to try and get a template version to then say to the collective community, this is happening, this is why it's happening, and this is information you need to provide, and it's not just some weird exercise that the exchanges are trying to carry out for a self-serving purpose.
There's maybe a very quick point that I would like to throw in more as food for thought than anything else at this stage, but maybe still worthwhile, certainly in this community, to say, and that is that both the CARF and DAC8 technically foresee the opportunity to replace the current paper-based due diligence procedures with digital procedures, and it's very open. So I mean, I also certainly you don't think that I'm in the position to now say how that should look like. But it's sort of in the framework of trying to make this more customer friendly, more business friendly. I think there's certainly an opportunity for initiatives that would basically replace a paper-based KYC self-certification with something such as an identity token that could be used across different actors. The reason why it's not more explicit is because it currently doesn't exist in a reliable way, but I think there's plenty of opportunity there, and at least from a purely legal standpoint, that's an option for complying with these obligations.
Awesome. I think we have a question. Is that right, Michelle? Oh, open it up for question. How much time do we have left? Time check? 15 minutes? Okay, awesome. I'm just going to hit on one important point that I think I see a lot of confusion, so it's why I want to talk about it on our panel. Dion, you brought this up. DAC8, basically, the EU said, you're welcome. Every single country in the EU, you have to comply with DAC8. And I've even gotten this feedback on calls. Oh, well, certainly not every country has to, you know, comply. They'll issue their own set of local implementation, which they could. But DAC8 versus CARF, for all the jurisdictions outside of the EU, you actually have to say, raise your hand and say, I'm going to participate, like we saw. So Max said, you know, furiously grabbed me this morning and said, we're up to 67. I think we were 66 yesterday. So every day it is increasing. CRS, I think there's definitely over 130, right? Yeah, so that's just to say we're at 67 today. This is going to be a journey. We are just in the first phases. So it would be great, you know, both Paul and Dion, if you could just highlight the local implementation factor. And a lot of questions I get, oh, well, if they don't have their local implementation, surely that means I don't have to do anything.
So we've got a couple of quick different questions here. So with CARF, yes, they can implement CARF as its kind of negotiated as of the 13th of July 2022, if I remember correctly. That's when we came to the final position. And what they implement, as Paul and Layla's already presented, comes about what goes into the domestic legislation. But I think what you're going to find is most countries are going to use that as the base standard. Some may try to go place it and might add additional reporting information requirements, but that's not necessarily going to be the case. With 67 jurisdictions coming in, quite a few of them are worried about what's happening with crypto, and it's almost like if you're not part of the process, if you're not part of that journey, then you're going to miss out on getting the data, because you're going to have this question of equivalency, and which then comes down to that whole US point. If the US do not participate, and they really are quite keen to, and have been throughout the negotiations, then would they be able to get hold of the information? Now, with FATCA, which is not quite the comparable of CRS, you've got different levels of information reporting, but the US said that was an equivalency agreement, which didn't cause as much agreement elsewhere. Would other jurisdictions actually agree that anything, the 1099 DA reporting process from the US is equivalent with CARF becomes a big question as well. How most jurisdictions are looking at CARF, though, I have to say, from what I've seen from the implementation so far to date, is they are just following the basic CARF standards. And DAC8 helpfully follows most of what CARF does. We've got a question which we were debating about beforehand about extraterritoriality and the extraterritorial effect of DAC8. Now, MiCA, as we all know, has an extraterritorial effect. So if you advertise into EU citizens, you need to have an EU base. Now, DAC8 did include in the draft regulations a power saying something similar, but it got removed. But DAC8 still references MiCA as the basis of what a reportable crypto asset service provider does. Now, I've had this debate because I also do some lectures for the University of Amsterdam on this point with some of the professors there, like Dennis Post and Claudio. And, my position is because MiCA already mandates what a reportable crypto asset service provider does and is, then because DAC8 invokes that, then that still gives it that extraterritoriality. But we weren't too sure about that in our own conversations just before this panel. So, Layla, what did you think of that one?
Yeah, about that, I was thinking about, let's say, the operator, actually, under DAC8, which, I understand if we are actually not falling under the CASP, as is defined under MiCAR, and we are operator outside of the EU, and we are compliant with the CARF, so we might not even register or even report, under the DAC8. And the operator, actually, when he services a crypto asset, when he provides crypto asset services to European user, though this is the trigger for all this due diligence. So this is my understanding where the extraterritoriality is, but the thing is, and this is what I wanted to ask also Paul about, is for example, the CARF is meant to be the minimum global standard, because this is actually, we know that within the DAC8, we have to rely on the OECD commentary, but what is not clear, and we know there's difference between CARF and DAC8, both of these regulations.
Yes, so I would of course be odd for me to interpret European law, so I'll leave that to those that are better accustomed to do that. But what I can say, I think is two things: is that through the negotiation of the CARF, the jurisdictions that have participated in those negotiations and those that have committed to implement the CARF agree that this is the global standard for reporting on crypto assets, and so that means that in principle you are willing and able to implement the rules into national legislation, with of course the particularity of the directive process in the European Union. And so I think it's also important that to note that DAC8 has a switch-off mechanism for reporting in partner jurisdictions participating in the CARF. So there is it's not standing in sort of a separate universe, but it's very much linked up to the broader CARF implementation project. And I think also to answer Erin's question, the fact that you do not yet see regulation or legislation in all countries that have committed, I don't think is an indication that these countries are no longer committed, but it's rather a question of how long do internal processes take within ministries, within parliaments, within governments to prepare legislation. And some countries are, because of their system, quicker to do so. Others take a little bit more time. I think also each country needs to then assess what the relevant process is, whether this can be done through regulation or whether fresh statutes are needed. But I think so far there have been no indications amongst the community of, as Max said, 67, that there is any backtracking going on at the moment in that sense. So that makes us hopeful, of course. And I think you will see over now probably at an accelerated speed, see these regulations coming out as jurisdictions are preparing for first data collection and then eventually exchanges.
I'm still questioning that 67 because the US is still one of those. So we'll see how
so maybe it is only 66, Matt.
Well, the 67, including the US listed on there. So only one person believes that might happen.
Max, did you have a question, comment?
Comment?
Okay.
that was a bit loud. So two things here, right? First a comment, second a question. Probably, I'm not sure if it's going to be a very nice question, but it's the dark elephant in the room, right? Big elephant in the room is really about the application of the reporting requirements to decentralized finance. First remark I wanted to make about like difference between CARF and DAC8, and something that actually needs to be acknowledged as well is that under the purposes of DAC8, all the reported information can also be used for other purposes than taxation. So because DAC8 is part of the DAC regime, we have this information reporting requirements for service providers, and the reported information can actually also be used for financial crime investigations. And what we are seeing is that certain countries are now also using the CARF framework, or the foundation that CARF builds and implements information reporting regimes, which basically build kind of like a surveillance mechanism of like what's happening in the country, right? Brazil, for example, introducing transaction-based monthly reporting for all customer activity. I don't think that this is a framework that ultimately is only for the purposes of taxation, right? It's also about like what's like for jurisdictions to actually know what's happening in the market. And ultimately, this is also then the question, how, like to what extent do these information reporting requirements now apply to decentralized finance? And I think there's uniform consensus that it does not apply to decentralized finance. The question is always, what's decentralized, right? I think it's really about the question, ultimately, no one wants to regulate peer-to-peer transactions, but it's really about what is a DINO, what's a decentralized and name-only entity. And the question that I have right now is with the United States introducing their interface approach, so to say, by the end of last year, and with that now being most likely dropped through a CRA very soon, the question that I have is like on the level of the OECD, is there any kind of consensus? Paul, you don't have to give a specific answer to that, by the way. I'm just what I'm trying to see here is there any consensus? Because I mean, like, it's going to be a very, very important question that needs to be answered. Which players are in scope, right? Because ultimately, so for everyone, you are reportable under CARF by default. Whereas, for example, with AML regimes, there's a registration process, right? You fall under the AML regulation as soon as you go for a registration process. However, with CARF, by default are in unless you're out.
Well, it's good that we get an easy question shortly before lunch.
Do you want a time check on that one, though?
Yeah, no. I'll try to be quick and bring it to the essence. I mean, I think there are probably two things there that are relevant. I think firstly, and also to maybe, I don't know if anybody of you has doubts in that regard, but then I can take away those doubts. We are not currently working on a separate set of reporting rules for decentralized finance. So there is no parallel project trying to come up with new ideas about how DeFi could be subject to tax reporting. So, and the reason why I'm saying that is because I think that then actually does confine debate. Because if that's the case, then The question is, to what extent can existing or future players in the decentralized finance market meet the existing written out definition of a reporting crypto asset service provider? And so I think in that regard, the most work efficient answer from an OECD perspective would be to say the rules are the rules, and now it's for everybody to interpret. I mean, we might of course be a bit more ambitious than that and try to see if we can come up with further clarity in this regard. Those of you who are following this will have seen that we issued a very general, frequently asked question on this subject, I think in the second half of last year it was. And there is certainly interest in the working party to further evaluate what guidance we could issue, but I think, and I say that from the perspective of the Secretariat, but I think also for the vast majority, if not all members of the working party, one of course needs to be aware that it needs to make sense, it needs to be in line with the rules, and it needs to be practicable. So if it doesn't meet those tests, then it doesn't make sense to issue guidance, because the value for a host of different reasons would not be very great, if not negative. So I think that's a bit sort of the framework that we're in. Of course, it all works on the premise that we can find consensus amongst members to issue something in this space.
And just to add quickly, I think the big question here as to where does DeFi start and where does DeFi stop? What is DeFi? As you said, Max, decentralized in name only exists by just strapping a name DeFi. Is that sufficient to the protocol? And it's going to be how those rules get applied to what your guidance will be as to what decentralized looks like. And I know you're going to refer back to the FATF kind of rules, when you're looking at sufficient influence and control over the platform, and it's going to be really challenging to say this. I think this platform here is DeFi in principle, and this one isn't in principle, and then practice.
I know we only have a couple more minutes. Does anyone have any questions in the audience? It doesn't have to be as, deep as Max's. Any question is welcome. So I just did want to open it up in case there was any other questions. Okay. Awesome. Well, we are here. Information reporting in all these regimes is what keeps me personally in business. So we love to talk about this. And then after lunch, we're going to talk about, really going deep into, now that we understand these regulations a little bit more, how do we actually put them into practice and the many, many challenges. So I just want to thank you to all of my panelists. This was just fabulous, fabulous discussion.